Hey everyone, it's Ed Kime over at Quantcha, and welcome back to another day of the Quantcha Challenge. Today's going to be a pretty good day because we're going to take a look at some of the positions we have and don't expect to open anything new. I think we had some up in the market today, and so we'll actually just switch over. I encourage you, of course, to check out our offers. Always good for saving some money and having some great investment tools. So, here we are with the portfolio. As anybody following at home probably noticed that today was a nice up day. We've got almost a 1% movement up in the S&P. And this is after a few days of us seeing mostly down. If we could take a look where we've been over the past, I guess over the past week, what we've seen is we've seen some downward movement that's really kind of pushed back on on what was originally a fairly uh, positive beta weighted delta neutral strategy. And so we've started, I think it was last Wednesday, and we had kind of some up and down. Of course, the candles don't really do it justice because the candles are the opens versus the closes, and so they were opening low, but as you could see, like each day we were closing and we were kind of opening up lower. So we had a bunch of downward movement, and that's kind of had worked against us, and we'd especially gotten bitten a bit by the Microsoft bits moving down on us. I actually wanted to call this out, a little sidetracked here, but we've been adding in some more charting stuff to make sure that the quotes are more visible for people that are coming in. We got some good feedback about this being persistent. It used to be just visible on our overview page, but now as you navigate through and you pick different views, you'll see this stuff stay, and you'll also be able to switch around between the different views, the month data, 6 months out, and if you have your linked Trader account, you'll be able to get minute data. Uh, and even, of course, you can drill in. If you go to the expand, this will bring you to our full chart, so you can get all that data and zoom in and out, and all the fun stuff that you're expecting to be able to do with the charting software. But stepping back to the S&P real quick, I also wanted to point out that for the charting we have here, there's three options at the top. By default, the middle one is the scroll, which means that as you scroll up and down, it'll just scroll the chart. If you want to hide it, you can just click the hide, and it'll hide that from you, so as you navigate around it won't get in the way. Or you can pin it, which means it'll persist at the top, so as you navigate through pages and you search for stuff and you go to different things, for example, if we go to the option chain, it'll just stay here. I like to keep the scrolling. This is much more friendly for mobile devices and small screens, but we got some good feedback on that, and we've been able to apply that, and hopefully everybody's enjoying that now. So getting back to the portfolio, um, there was a kind of an interesting thing happened today, which is we saw some good movement up, and we saw most of the portfolio have the names that we own move upward. And there's a couple things that I'm going to call out here. One of the main things is we're seeing good movement up in Carnival, which we're bullish on. Johnson and Johnson, this is a was a straddle, so we just want to see movement away from the 128 point that we opened the straddle at. So the further we can move, the better. Microsoft is recovering nicely for us. We had this covered call that we were kind of sitting on, that we were a little worried about. Starbucks, I'll come back to Starbucks in a second. Exxon's still kind of trending downward, which is what we had hoped for. We are bearish on this. The Starbucks trade here, this is the interesting thing. Now, you notice that the book right now is down 289 on market pricing. But if you take a look here, the Starbucks book that we hold is down 340. And the initial reaction that you might have to that is to say, well, oh, we shouldn't have done the Starbucks trade. Like, the Starbucks trade really shot us in the foot. But what actually happened here is that we opened up a trade that we went out there and we said at the time we needed more beta weighted, we needed some negative beta weighted delta. That was the purpose of opening this trade, to get this number, this negative number here, so it could bring this closer to zero, so we would be less, we'd basically be less vulnerable to movement in the S&P. And what we got today was we got some movement up, and you can see we're close to zero. Um, and this is kind of where we want to be. We want to not be dependent on the market moving, but more importantly, we don't want to be at risk because of the overall market moving. And so, getting back to the pricing here, like, yeah, we can look at this and say this is down, but I'm pretty happy about this money moving upward, because if you look at the book across the board, this is a positive trade right now. I mean, the market pricing's negative because we're using the bid and the offer to decide how we would close it. But realistically, we open this at 90 cents, and a good way to see what you can get on the market is to just try to close the book. So from the actions drop down, closing book or close book is a good way to just go to a trade ticket that's pre-populated with what you're holding, and it'll try to close the whole book out. And we could probably closes it buying it back for 80 cents right now. So as you can see, it is up a little bit. So there's a bit of profit there. And I'm just going to step back to the portfolio though to talk about a few other things. Um, the the Microsoft recovery we got here was nicer than we had anticipated. I expected it to be around 105 by the end of Friday. That's why we sold the call here. It's been kind of flirting with that. If we take a look at the daily movement, we could see it was up. It was around 105 for a bit. It's kind of been up and down from there. And the question becomes at this point, do we do anything to manage this? Like, what is our goal with this? And at the time we opened it up, stepping back, the trade plan for this particular uh, for this position. Sorry, it looks like we're having a little bit of connectivity there. The trade plan for that Microsoft covered call was simply that we wanted to go out there and place the trade, and the goal was to put this in play. And the reason we went so short is because Microsoft has earnings coming out on the 30th, and the idea was we're going to open up a trade, give ourselves about 10 days out. Hopefully, we can make some profit on that, potentially roll it out one more week, and then get out of Microsoft for earnings. Because as bullish as I am about the company overall, I don't really feel like playing earnings with the stock right now. We're just going to avoid that. So the position we're in right now is actually pretty good because we're up on both the shares and on the option because the call option is about reduced in value. We've gained about 40% of the potential profit there, actually a bit more than that. So this comes up as a question is, do we do anything as we stand right now? We've got 4 days, which includes today, until expiration. So if we go into manage the book, we can take a look at what some of the what some of the options are, for lack of a better term, to see how can we manage our book here. And right now we're going to pull in all the options, take a look at a bunch of different analysis. And the key thing that we want to see here when we're working with the Microsoft book is if we were to roll this option up, if we were to take this option and go to, let's say, the same week, but we were to bring the strike price higher. Right now it's 104.57, but if we were to bring it up to, let's say, roll the strike price to like 106 or 107, it's going to give us a little bit more run room for the stock to move up. But at the same time, it's going to also, we're going to be leaving some of the potential money on the table in the event that the product drops, right? If Microsoft goes down a little bit, then we would be looking at kind of a loss in the value that we were holding on to. Seem to be having a little trouble getting connected to Tradier at the moment. Oh, sorry for the technical difficulties here. Not quite sure what's happening. So yeah, that was strange. It's not something that we see very often. So going back in, if we take a look and we try to manage our Microsoft book, we're going to load this up and we see this is our current P&L for Friday. And this would be because we have this 105 strike that we're short, which means that we can appreciate the stock in value up until we get here, and then at that point, every bit we gain from the stock is lost to the options. So let's take a look at some of the rolling options we might think about. So if I click the roll button, that's this third icon here next to the option that we're short. You can see that the pending book view is pretty useful in that you can come in here and make any changes you want, or you can add things using the add stock or add options, and these all simulate different ways to adjust the book you have now. And none of that's going to impact what you actually hold. All that's going to do is it's just going to make changes in this pending world that you can then compare against what you currently hold to see if that's the P&L that you really want. So as an example here, we're short the 105 call for the January, which is 5 days out, or rather this Friday. And what we can do is we can select from the drop down and say we want to roll to, let's say, the same January expiration. And from the 105, let's say we were going to roll up. This will be interesting because in this case, if we wanted to roll up to the 106, what that means is we're going to buy back the 105 and we're going to sell the 106 to replace it. Now these numbers here show the data of the impact to the book. This is the bid and offer that's currently available. So presumably we would price this as though we had to buy it back at the 80 cents and we would sell it at 40 cents. And so there might be some fractional involvement there. But that means that the change for us would be it would cost us $41 to make that trade at the moment. And if we did that, it would also give us a change in this should be our delta, just to make sure. Should probably make that persistent headers. But this is, it's going to lower our delta, it's going to lower our gamma, and have the impact on the Greeks that you might expect. But if we click roll, it'll add it to the book, and it'll keep track of it, what that simulated transaction was. So we can now come up and take a look at what the different P&L is. Now, if we were aggressively bullish for this week on Microsoft, we might place this trade now. I wouldn't recommend it. I feel like we're just going to kind of hang out. For me, when possible, I prefer to roll down if we can get more credit. I'm not a big fan of rolling up. A lot of people say that a good rule of thumb is to not roll into a debit. In other words, to not pay to roll. You want to collect more credit, especially on trades like a covered call or some of the other spreads you might have. But there's, again, there's no hard and fast rules here. Sometimes the opportunity comes out and presents itself in a different way. But for now, we're actually going to stick on it. We're just going to stick with this covered call that we're looking at here. If I jump back to the portfolio, the one of the trades that I'm a little worried about is obviously the Starbucks trade. We've got 4 days until it expires. If we just sit on it right now, it is pretty far out of the money. And by far, I just mean it's entirely in the money, which means that when we go to close it out, we'll either have to buy to close it out and pay a slight liquidity cost, or we'll let it exercise, and we will get hit with the exercise fees. It's not a lot of money, but it's still something that we definitely prefer to not have that. Now, if I were to take what we're looking at here, we can actually go in and we can choose to manage this book as well. And this book management will give us some, like we were looking at with the Microsoft stock, it'll give us a bunch of options for how we can trade it differently. Now, let's say, for the sake of argument, that we see that the stock has gone up to 64, and we think that it's very likely to stay below 64 by the end of the week, but we don't know necessarily that it's going to hit this 63.50 mark, or that we'll even feel particularly good about holding it for the risk, because obviously we need to get below 63.50 by expiration, or else we're not going to get any real benefit from it. Now, there's a couple different ways to go about doing this. The main thing you would do is just like we did before, is you would be able to just roll the trade. Like maybe what we would want to do here is say I've got this 63, instead I'm going to bring this out to a 64, and say if I rolled my 63 up to 64, and then I'm going to take the 63 and a half that we are long, and we're going to roll this up to a 65. Now, this is a good example of the analysis where if we did that, we'd be looking at more likelihood of profit. We definitely have a better opportunity of profit for the situation we're in now in terms of our future outlook. However, an important thing to understand with how this is set up is if we take a look at the track changes we're making here, it's going to cost us money to make that trade. And another way to think about that is because it's a credit spread, if it's going to cost us money to roll it, then what we're doing there is we're locking in some of the loss. And the position we stand in right now is the entire cost of the trade, if we were to go all the way to expiration, is going to be, it's 17 contracts at a 50-cent spread. Oh, actually, I rolled this guy up too far. I just want this to be a, sorry about that. I just want this to be 64 and a half, so that we're keeping that 50-cent spread that we were looking at earlier. So the current book we have is the 714, and that 714 means that we're down. If we had to close this out right now, this is what we would have to pay. Now, this isn't the entire loss because we did receive credit to open the trade in the first place. Now, if we were to take this and close it out at 714, the maximum loss for a 50-cent spread when you have 17 contracts is that 1,700 times 50 cents. For each one of these representing 100 shares. So that would be, in our case, $850. So really at this point, there's only about $135 that are out there that are available. So what we're really thinking about here is if we hold on to the position right now, would we open a $153 trade to get this blue line P&L as we hold it today? And odds are we probably wouldn't. Frankly, I don't think that I'd want to open that trade. So as a general rule of thumb, whenever you're looking to manage the positions you're in, if you wouldn't open the position new now, you probably don't want to stay in it. Of course, this is going to vary depending on on how you really want to approach your option trading. But if you find yourself thinking about those out of the money calls you bought and the stock went down and now they're worth pennies, uh, would you buy them today? Well, you probably wouldn't, but at the same time, it might not be worth it to close them. So this is kind of where the trading, the hedging tools come in for our book management, because it gives you an idea of some of the options you could have, and maybe you'd prefer to be in this position here. Maybe we want to move it up, but the issue that I have with us actually implementing this different strategy is if this were a longer time horizon, I'd probably just stick it out with the blue we have now. Uh, if we're looking like 3 months out or 6 months out, and I felt I was still convinced about the bearish view. On the other hand, if this was a weekly trade, as it happens to be, and there's 100 and change left over, I'm definitely more inclined to say, well, let me try to take that money. And since I feel unlikely, perhaps I might feel unlikely that we're going to see full credit, then let me roll it into something that has a higher probability, because we can see if we make this roll, we have a much better probability of making money. Now, what's interesting about these things that comes into play is that the probability of gain is lower for the current position we have, but we have a higher potential return, and that's because it's a more leveraged risk. Uh, these returns here, they don't account for what your cost basis is. They don't really care how you got into the position you're in now, which is kind of an approach I would recommend people take when they think about the investments. Is don't worry so much about your sunk cost. What you paid to get the options you're holding doesn't really matter when it comes to making the decisions about what you should do now, with the exception of potential tax implications or things like that. When it comes to saying how do I maximize the return, you have to live in the now and say, what do I have now and how should I trade it? And so this would be one of these situations where we provide this UI because it helps give you that simulated return, saying, look, there's a lower probability of actually turning a gain here, but we've got a much better chance at a higher return based on the probability curve here. And this is our implied distribution, which is based on the implied volatility. This is sort of like what the market has decided the probability of these various endpoints are. And if you mouse over one of the lines, we can see, for example, our maximum return here at this one volatility movement, you'd expect to see it to be about 15.9%. That's about right, meaning that there's a 15.9% likelihood that the stock should close below here based on the options math that underlies the pricing that we see in market right now. So if we really look at the inflection point to get full profit, there is still about a 22% chance we'll get there. But more importantly, the pricing that we get, we get about that 33% mark about getting a profit at all out of the trade. And in this case, we're not gonna pull this trade out here. But the other thing I wanted to call out is that you don't always have to move the entire spread. Something we can do here is, for example, if I go into our track changes, I noticed that what we did is we bought this option here. It might be a little tricky to to follow here. We're currently short this, so we had to buy it to close, and then we sold this to replace it. One of the things we can do is, instead of doing that, is we say, since we're short this 63 call, what we could potentially do is we could move up the calls that we're long. So what I'm really getting at here is, let me reset the current book. So this is where we stand right now. Now, the position we have now is these calls have actually appreciated. Even though the entire value of our portfolio has gone down, we've gained value on these specific calls. So another thing we could do is we could try to lock in the value of the gain on these calls. And if we either don't expect Starbucks to keep moving downward, or if we expect it to potentially revert, or we don't expect it to keep moving up, we can kind of lock in the gain on these calls and just roll them to a higher call. So for example, we're at 63.5 here. Let's say we take the January expiration, and we're going to experiment and say, what would happen if we rolled that up to, let's say, 65? Now, in rolling that up, the main thing that's going to happen here is we're going to sell that off, and we're going to get quite a credit for it. Because that roll here is going to generate a bunch of money, because we're selling off an option that's worth $1,400, and we're buying one that's worth $272. So we're going to get a net credit of about $1,200 if we shave in the spread a little bit. And it'll give us a P&L that looks like this, a much wider P&L, because our strikes are further apart. Now, as you can see, there's a deeper trough here. So in the event that this trade, if Starbucks just keeps going and it moves against us, we have a lot more money to lose here. the versus what we have left to lose on our current trade, that 136, we could go down and lose another, $1,300 here, 1,400. So that's the case there. But we also have a lot more to gain, because what we're doing is we're sort of like we're doubling down on our bearish bet here. We're saying we feel even more confident that it's going to drop, that we think that it's sort of peaked out here, and we're seeing the action on the day. It is starting to kind of trend downward again. Since we're seeing that, we could feel pretty confident, or if we did feel confident, I should say. I don't, but if we did feel confident that it was going to turn around and do it, and if we were directionally trading Starbucks for the sake of trading Starbucks, that would be what would happen there. So the big risk, though, to keep in mind is because we have that huge trough where we can lose money, it's going to impact our maintenance margin. So right now, because we have these 17 contracts at that 50 cents, the most we could lose, or the most we would owe when this trade comes to bear, would be as if our brokers needed us to pony up $850, which would be partially offset by our original credit. Now in this case, if we moved it out to a $2 spread, then we've got 1,700 shares under control for a risk of $2 per share. So that's where this $3,400 comes from. This would be the money that would, it would use part of our credit here, and we'd have to bring up a little bit extra cash ourselves. Now, this has been largely an exercise in just kind of experimenting with what would happen here and how we might approach it. If we recall, the original purpose of the Starbucks trade was to help us keep our beta weighted delta close to zero. Now, as you can see, the change here, if we did this, we would be blowing it out. We'd be going pretty hard negative on the S&P, which we're really not. Right now, we're just trying not to take a position on the S&P, but rather have some, fairly equally weighted bullish and bearish positions that'll go ahead and counter each other out. So this is just something I wanted to cover on a little bit here. Now, I did get a question earlier today, which was an interesting one about really exiting spreads. And there's a couple things that come into play when you think about exiting a spread. One of them is, when your timing for exiting, like when you want to exit it and why you'd want to exit. And then, of course, another big one is if you're going to exit a spread, the big question that comes up is how do you do that? Especially if you're a new options investor, like what's the process to go through for getting out of a spread position? And unwinding a spread position is really the same as it would be for opening it. So let's take this Carnival position that we have right now. Now we can see that we are long 3 contracts in the 50s for February and short 3 for the 52.5s for February. So there are a bunch of different ways. Now we could go directly to a trade ticket, right? If we went to the trade ticket, it would give us a blank ticket. We'd load it up, we'd fill it with whatever we wanted, and we'd have to manually enter the positions, which we could do. We will skip that here. Instead, we'll use the tools because the tools go a long way in helping us just automate things. It removes some human error, and also it just makes us be able to get to market a lot faster. So there's a bit of trouble opening the portfolio view today. We'll have to double check and see if we can find out what might be going on behind the scenes here. The thing we wanted to look at for getting into the trade ticket as well is if you're going to trade, a thing I like to point out is on that trade ticket page, for example, we have the portfolio. In this case, we're looking at our Microsoft symbol, and in our portfolio, we have 100 shares that we're long. So you will get, under a quantity box, you'll get a notice about that. So if, for example, we change to options and we happen to be looking at I think we're short the 105s here. So if I were to bring these up, it'll also tell me, hey, you're currently short 1. This way you make sure that you're only doing that. An important thing about options is because we're short 1, right, if we tried to, let's say, we need to buy to close in order to get out of it. We tried to buy to open this, and we're short 1. If we try to do that, we'll just pick a ticket. We'll say preview the order. You'll notice, say, we can't place an order for a short position if we're already short. I'm sorry. We can't buy a long option if we're already short that option. So you definitely have to be sure that you're going to buy to close an option that you're currently open. And this works for spreads or covered calls or any kind of option position. This is something that new investors struggle with a lot of times is how do you unwind a position or unwind a trade? And it's pretty simple. When you can't, if you're flat, you have to open, either buy to open or sell to open. And if you already have positions, then you just go the other way. If you have to buy to close or sell to close. Now in this case, because we're already short 1, if I decided that I wanted to flip my book and be long two of these options or long one of them, let's say, then I'd have to buy two options. But there would have to be two separate transactions. I'd have to buy to close one of them, and then I would have to buy to open another one in order to get myself from that negative one to positive one. The good news is, though, if you go with a commission-free offering like we have with Quantcha Unlimited, you don't pay for that. You don't pay for the commissions there. You just get what you're looking for. So um, the we were looking at, I think it was Carnival, so I wanted to just get back to this as an example. Oh, another thing too is you can close out or at least go to a trade ticket. So let's say that we decided right now we're really happy with the movement that Microsoft has made. Right now we're up, our stock's up, or it's about break even, but it's up by $5, and we've got a bunch of money we made. We made half the profit on this option. So maybe what we decided is we're going to be a little bit, maybe we're going to be a little more aggressive, and we're going to close out this short call. We're going to take our little bit of profit, and we're just going to keep it uncovered for the time being. We're going to have 100 shares. What we could do there is I could just click that little close button next to it, and it'll give me the ticket for that one option. And then I can say midpoint, preview the order, go ahead and close it out if I wanted to. The other thing too about the ticket that I wanted to point out is there's market price and then there's midpoint price. And the market price simply means if you have to buy the options, we use the asks, and if you're selling the options, we're using the bids. So on any combination of spread or anything else, it's going to be the aggregate of all those prices by the amount of quantity, and then trying to figure out on a per share basis what that trade is. Now, the reason we do that way is because at the market price, it's still going to give you a limit order. Now you can go market if you want, which is going to be risky because you don't really know the depth of the market at all times. So sometimes you have to go market because you just need the fill as fast as possible. But if you have a second and you just want a fast fill, you can go to your market price, click on it, we'll pre-populate a limit order with that market price. Or we've got the midpoint price, which is, as it says, we average the bid and the ask, and we find out where it lands, and then move that down here for you. And then we always have the preview order, so you can preview it just to make sure the stuff makes sense, and then click submit if you want to execute. But I was showing that for the individual trade. And then the last thing, just to kind of complete the story, is using that close book option. The close book option will go ahead and it will give you, it'll pre-populate the ticket for all the positions you have. So if you're building up a sophisticated book and that book has many, many different positions in it, then what you could be looking at that point is you might be looking at something that's unwieldy to close. But in the case of like a two-leg spread, just something that's just, for example, your long and short are Carnival options, then you can pretty easily go ahead and click that, and it'll bring you to a close ticket with those two legs pre-populated. I'm treading a little water here. We're going to have to do some looking at the logs to figure out what's going on here. Not sure why we're having such difficulty with the portfolio today. Portfolio view has never acted up on us before. We got to find out what's going on behind the scenes. But like I said, we weren't going to open any new positions today. We were pretty happy with what we were looking at in the current book. Now, we are still down. We're not super aggressive because we're trying to keep the volatility relatively low in the portfolio. So, got some surprising errors here. We'll have to, like I said, we'll have to go back and dig through what's going on there. It's tough when it happens on a live webcast, but yeah, we'll dive in and get to the bottom of that. Make sure that hopefully it's just us seeing that. But again, just a quick review of the portfolio as we get close to the end of the day. We're pretty happy. Again, Carnival seems like it goes up every day for us by a little bit, and yet we're always kind of right around that because we're far out. We're 32 days from expiration, and the liquidity is not great on the options, so we're looking at kind of a broad spread there. We're going to keep a close eye on the Johnson & Johnson trade because we really do need it to move quite a bit one way or another before earnings. That's sort of the bet we're making here, is we're trying to get this straddle on and lose as little time value as possible in order to make as much as we can when we sell it off on Friday before earnings gets announced Tuesday morning. The Microsoft, we're going to just continue to watch Microsoft. It looks like it's starting to come down on us today. Starbucks, we're going to hope for a bit of a drop. In the event that it doesn't drop, what we might do is we might put in an order to sell. I think that probably something we're going to do tomorrow is come through here and figure out where would we be happy to sell these trades and then put in good till canceled orders. It's a really good practice to do that. For example, let's just take the Carnival trade where we open this trade at a 90-cent credit. So one of the things that I often like to do is to take the trade like this and look at it and say, well, if we went for a debit to close it, we opened it at 90 cents. If I could close it at 45 cents and just leave that order hanging out there. And what this will do is, and I'll actually submit the order because I'm pretty happy with that. So this order is just going to sit out there. Good till cancel just means that, hey, just keep it out there. Don't expire it at the end of the day. And then if we ever get to the point where we can close out the trade for half of what we received, meaning we've received 50% of the credit, it'll just happen. And sometimes this will happen early in the morning when the market first opens. There's going to be some volatility and you might get a better fill than you expected just because the underlyings move around a lot. Or it might happen at any point. I also like to do this to kind of put it on cruise control because when you have trades that are sitting out there like this, there's less chance to get in your own head, and that's definitely something that I think that people want to avoid. Is you don't want to get in your own head when you're trading and think like, oh, there's more profit that I could get out there. And as we get further along and we've got trades getting to expiration and so on, it'll be a better opportunity to kind of look through these trade opportunities. But for now, we'll just leave this sitting out there. Maybe we'll come in tomorrow and do the same thing for Exxon. And actually, the other one I'm going to do here is Johnson & Johnson. I am going to put in one more order here. So when we opened it, actually, I need to step back for a sec. I don't remember what our cost basis was for that. Can we get it from our orders? No, our orders are just from orders we had a few days ago. The other thing is the orders are just the orders from your current day's orders. Everything else goes into history. But when we open this up, it looks like it was $2.67 was the trade. I'm sorry, $4.67. So if we're going to close it, I'm just going to put an order right now to say if we can sell it for, let's say, $5.50, that would give us a pretty nice profit. I mean, it's not unreasonable. I mean, tomorrow what we might see is maybe it's going to open up $1 more or $2 more or something, or maybe it's going to drop $5 overnight, and we'll be leaving some money on the table for the potential. But if we knew we could lock in a trade for a win at what would probably be about 20% right now, I would take it. So we'll just leave that trade. Oh, I actually messed up that one, so I'm going to change it. It's easy to click and change and just come over to duration saying good till canceled, and then we've got our net credit. We'll change that order. So that's just going to sit out there. And this is just some of the basic this is just some of the basic housekeeping you'll want to do on a day-to-day basis when you're looking at your book and figuring out. The other thing too is these good to cancel orders can be opened at really any time. So I'll often do it after hours, just as I'm either on a weekend or at night when I'm just reviewing the portfolio. Just put the good till canceled in on anything that I don't want hanging out there. But this is run on now for about half an hour, so I don't want to hold anybody too much longer. If you've got questions and comments, please keep them coming. If you have any feedback, leave us a comment below. I'm starting to see some comments come in, which is great. And also hit us up at hello@quantcha.com, or you can tweet to us too at Quantcha. We spend some time on stock twits and even on Reddit in the options sub. So any of those places are great. Raise up something with Quantcha. We'll probably find it pretty quickly. In the meantime, we're going to go do some drilling in as to figure out if we can get to the bottom of what's going on with these portfolio requests. But as always, good luck and good hunting.